Hello students, let us understand about indifference point in capital structuring. So before getting into indifference point, let us understand capital structuring first. So what is capital structuring? So it is nothing but the combination of different sources of finance. Say for example, to raise funds for the business, we need different sources like banks, we'll move for debentures and another different sources like equity, preference, R&S, that is reserves and surplus. So there are different sources, and capital structuring is nothing but combining all the different sources. Say for example, it is the proportion of equity, preference, debentures. So say for example, equity let us take as 50%. So debentures let us take as 50%. That is what the mixture of debt equity mix. So what is this EBIT EPS analysis? We know about EBIT, that is earnings before interest and taxes. So how to find out this EBIT? So we know the framework like from sales, if we deduct variable cost, which gives a value called as contribution, and from the contribution again if we deduct fixed cost, basically there are two costs, right? One is variable, another one is fixed, and from contribution if we deduct fixed cost, which gives earnings, that is EBIT, right? So from this EBIT if we reduce interest alone, it gives EBT, earnings before tax, and again from this EBT we need to deduct tax from this EBT. After deducting we can say that is earnings after tax or profit after tax. So that is EBIT. So how to find out this EBIT EPS analysis? So this indifference point, it is also called as EBIT EPS analysis. EPS is nothing but earnings per share. So for a business, capital structuring is very important, and it is not mandatory that only one capital structure has to be framed. There are many different kinds of capital structuring. So here we can take as capital structuring 1, capital structuring 2. Yes, fine. For both of these capital structuring, there might be two different EPS, that is earnings per share for 1 and EPS for 2. Okay, so they are telling that there are not any difference between these two capital structures, right? There is not, that is why it is called as indifferent, right? So for a business, two kinds of funds are there. One is owners funds, another one is outsiders funds. So owners funds if we take as 25%, just an assumption, and for outsiders funds, that is debt. Okay, so that we take as 75%. So owners is 25, debt is 75. So who gets more profit over here, right? So after getting such a huge profit for a business, for that company, obviously see this 75% debt is what fixed one, right? The interest that what you are paying, or else the dividend that what you are giving to your shareholders, interest, whatever, that is something that which is very fixed. Okay, so even if you get more profit, okay, so you need not to pay the extra, the growth level to your data, so to your the outsiders. Okay, so this additional profit, obviously it just it helps for the owners. Okay, so all the additional profit which is what gained by the company, so it is completely in the hands of owners. So this is what EPS 1, that is for first one, and per share for the second one. So EBIT minus, that is if we deduct interest. Okay, so next is 1 minus t is nothing but tax deduction along with the interest. Just now I told that, from EBIT we have to reduce interest, and from interest again if we have to, we need to deduct what is that, tax. So that is 1 minus t. So let us take that for first capital structure preference is there, and for the second one preference is not there. That is why it is given here as PD, preference dividend. Okay, and the second one it is not mentioned there. Whatever, so these two things are equal, both the capital structures are equal, which gives a bit as a whole, and that is what the indifference point that what we are trying to convey now. So both the capital structures, so it is what, same, it should match. Okay, so this is all about indifference point in capital structure.